How are you kind of navigating through this volatility we've seen in oil? Do you think this is really going to add to more of this inflation risk across these markets?
Yeah, thank you so much for having me. I think obviously this adds to the pressure of the inflation risk and clearly was a surprise for many market participants. But I think when we take a step back and we look at the recent kind of, I would say, weakness in oil demand and also kind of the increasing in recession risk, I think it made quite a lot of sense for the OPEC to consider this cut, kind of to proactively preempt the global slowdown and also, I would say, ensure price stability. Now, at Saxo, actually, we've been communicating to our clients since late last year that we feel that at least for Q1 this year, that oil prices would be range-bound, which it has. But having said that, chances are the uplift will really come from later in the year, more backloaded. And I think, obviously, what this has done is kind of speed up the overall view of ours that we would see between $80 to $100. And clearly, this has broken the bottom end of that range already, and that's something that we're actively monitoring. But one more thing I want to mention to clients as well is obviously right now it seems like oil prices is surging, but we feel like with the kind of the slowdown risks ahead that they're probably short term, maybe for risk for actually oil to drift down lower. So investors should be aware of this as well.
And so I'm just wondering, what does it mean for central banks and policymakers? Does the Fed? Is a pivot less likely or more likely now? And should we be more focused on the growth concerns than the inflation risk now?
Yeah, I think the biggest risk for me is really looking at the gap between the expectation of what the market is expecting or what investors are expecting and what the Fed rhetoric is showing in terms of the Fed policy path, right? So right now, when we look at what the market is actually pricing in, so it's pricing in its rate cut as early as September, potentially like a half cut for the Fed fund rate, and also about 30 basis points on the peak terminal rate. But when we look and analyze the Fed rhetoric and also the data, we think this is completely not supported. I think on our end, actually, what's actually important to highlight is the fact that probably the Fed will be following much more the ECB approach, which is letting the market know very clearly that inflation is not over and the fight continues. And I think right now, obviously, with oil prices surging as well, this only adds to the pressure that and supports our view that actually rates will stay higher for longer. And I think particularly the fact that we feel that recession risk is kind of creeping in, maybe towards the end of the year. There may be, at that point, I would say maybe Fed cut in terms of actually stimulating the economy. But for the time being, rates stay higher for longer.